Still with us are Kristina Hooper of Invesco and Bloomberg's Tracy Alloway. Tracy, I'm going to pick on you for a minute here on the debt side. Borrowing money at double-digit numbers. We're not there at this point.
No.
But at the same time, what is this environment we just described going to do for the asset of fixed income?
Yeah, we were talking about financial conditions earlier, and I think one of the weird things about recent market moves and history has been how sanguine the credit markets have been about inflation and higher interest rates. And I've seen various theories. Today we actually finally saw leveraged loans, the benchmark index, down to like $93. But even then, 85 is generally considered the distressed level. So what's going on? One theory I've seen, and it's kind of a sort of moral hazard argument, but there are people who say because the Fed came in last time with the corporate bond purchasing program, maybe that's one reason we haven't seen the market panic, because they think if things get bad enough, well, the Fed will come in and it'll buy some bonds. Well, last time it didn't even have to buy bonds. It just announces that it's going to buy bonds and everything is fine. But I think people are looking for that pressure, and you are starting to see some signs of it around the edges. So for instance, we saw CCC rated junk bonds today take a little bit of a hit, but not nearly what you would have assumed looking at stocks.
So what's your reaction to that, Kristina? Is any form of fixed income right now sort of a haven in this very tumultuous time in the markets?
Yeah, I mean, first I have to say it all depends on your time horizon. And so I believe very strongly that it's important, if you've got a long time horizon, you shouldn't panic in this environment. I mean, let's look at fixed income, floating rate, but there's a variety of areas. Investment grade credit looks good. I think we just have to recognize that we're going through this adjustment period. We're going back to the old normal. I mean, presumably, if the Fed doesn't cut rates again, right? And that was a time that was fairly good for equities and fixed income. I think it's important to have alts in there, too. But it is not the end of the world, as we talked about before. It's just we're going through a change.
When we're talking about fixed income, whether it's loans or it's bonds, we had one story this week, Citrix, where they basically were borrowing a lot of money, and the banks went out and syndicated it. They thought it would be just fine. They ended up losing something like $600 million in the deal. They had to eat that money. What happened there? Is that a one-off, or does that say something broader?
Well, to me, this is sort of the tail end of that buyout boom and a lot of the credit market excesses that you've seen in recent years. And one reason why leveraged loans in particular are getting so much focus right now is because if you look at which asset classes had the most, I'm going to say enthusiasm, leveraged loans would be one of them. We had concerns about the quality of some of those loans for a while. We had, at various points in time, U.S. regulators trying to improve the quality of the market. And now as interest rates get higher, a lot of that pressure lands on floating rate loans because the companies that took them out are going to have to start paying more to keep up with those benchmark interest rates. And that's why you have people who are, well, at Morgan Stanley, for instance, who are looking at the leveraged loan market as the sort of canary in the coal mine of how the market is viewing recession risk. But again, we're not quite there. 85 is usually the level of distress. We are at something like 93 now. So further to go if you're really looking for a sign that the market is panicking.
Kristina, if that's a fixed income, what about equities? Does it make any sense to buy equities? Typically, when the discount rate goes up, equities go down. And certainly we're seeing that right now in the equity markets.
Sure. Well, I do absolutely believe that. Unless you have a 3 or 4 month time horizon, you should be keeping your equity exposure and looking for opportunities to add to it. Yes, there is that adjustment period when rates go up. We do see equities tend to go down. But we also tend to see a recovery. It doesn't last forever. In fact, during a whole Fed rate hike cycle, usually by the end, we come up with positive performance for equities. And leading the way is typically the higher valuation names that got hit hardest first. So this is to be expected. It's not fun, but it is to be expected, the kind of behavior we're seeing given the kind of dramatic increase in rates. But that is not the end for equities.
So you might actually add, at least selectively, to growth right now?
Absolutely.
Is it coming out of it faster than the others, do you think?
I do believe that, for sure. Valuations are higher there. They tend to get hit hard, but there are also significant growth prospects, growth potential there at a time when the economy is clearly slowing down.
So, Tracy, what do you see in other asset classes? And let me name two at random: cash and commodities.
Cash, I mean, cash is looking okay right now. I guess you're only losing 8% per year versus what, like 20% on some other stuff. But when we're talking about cash, I mean, it's got to be in the dollar. That's the only thing that's really working at the moment. Cash, we used to say cash is king. Now we say the dollar is king. And not only is the dollar king, it is a king with a wrecking ball going through other asset classes.
But from what you said, the very fact that the dollar goes up makes commodities go down in general over time. And so that means commodities aren't so attractive, you think, to investors right now.
Oh, that's exactly right. And I think that's one reason why the recent environment has been so painful for a lot of people, because think back to the beginning of the year, commodities were seen as this inflation hedge, a bit of a risk-off hedge. You know, if you're worried about what's going on with Russia and the Ukraine, you can buy some wheat exposure, buy some oil exposure. You have a nice little offset to macro risk that shows up in the sort of headline indices. That's not working anymore. And I think that's one reason why the environment's been so difficult for investors. The only good news that I kind of see here is, you know, people have been having to deal with these really binary potential outcomes for most of the summer. You know, does inflation stay high? Do we get the dreaded wage price spiral? Or does the Fed come in, raise interest rates, bring down inflation, and you get that knock-on recession effect? I think the good news here is we're moving away from that really binary, tail risky environment, and we seem to be moving closer to that recession scenario. I know I'm scraping the bottom of the barrel by saying recession is good for investors at this point in time, but at least you know where you're headed.
Well, that's what we're looking for, though, is where might investments go north, actually, in this difficult time. Kristina, what we haven't covered is alts. Alternative investments, real estate, things like that.
We need to have exposure there. We advocate something akin to a 50-30-20 allocation, and that would include in that 20% alts bucket a nice healthy exposure to real estate income. You know, clearly the more conservative real estate makes more sense in this environment. You know, I think there's a lot of concern that there's so much structural change going on that office space, for example, you can't trust or can't rely on in this environment. But there are a lot of areas that are not part of the economic cycle that haven't been hurt by the changes we've seen in terms of hybrid working, self-storage, student housing. There are all kinds of areas that are very attractive right now in real estate.
So, Tracy, I'm sorry, go ahead, please.
I was going to say, I think offices might be a good hedge at the moment, because if you think about, you know, the M&A boom kind of dying, all the M&A bankers now get called back into the office because Goldman says business is slowing down, or Barclays says business is slowing down. You all have to come back, rents go up. I'm joking, of course. We're trying to be creative with the portfolio hedges.
Last thought, from your podcast, you cover an awful lot of the aspects of financial markets. What's the most controversial suggestion you've heard made about investments? What's the one that's just out there?
I'm trying to think. I don't think this is the most out there, but it's sort of a contrarian position that's on my mind, and it's the idea that everyone's looking for the war between Russia and Ukraine to come to some sort of end. What if it doesn't? What if we just get a sort of stasis scenario where Russia occupies some parts of Ukraine and that's the end of it, and the market seems to be looking for a sort of finite ending, and I'm not sure we're going to get it.